Good morning, everyone. Today is Wednesday, July 22nd, and welcome to 7investing Live. This is our live stream event we host every Monday, Wednesday, and Friday at 10 o'clock a.m. Eastern Time to discuss several of the market's most intriguing opportunities. My name is Simon Erickson. I'm joined by our executive producer, Heather Horton. Why a live stream show? Why do we do this? Well, it's just more fun to be out there on YouTube, on LinkedIn, on Twitter, on all the different channels to talk about things that we see as opportunities in the stock market. And if you have questions, ask us questions. Ask us live about the stocks we're talking about. We do have a live chat open right now. We encourage you at any time to subscribe to our channel or even watch live if you'd like to ask questions. We have a very cool show today. We're going to be talking about short squeezes. This is a market dynamic that's a little bit more of a technical indicator, but it's counterintuitively a very optimistic or bullish indicator. The stock price might be soon to go up. We're going to be talking about what does it mean to have a short squeeze? What are some of those indicators you can look at to find a short squeeze? We can look at how this actually played out for a short squeeze candidate in 2023. 3 years ago, and another short squeeze candidate that I see developing here today that was actually just named one of 7investing's best buys for July. So we're going to talk about all of those first and foremost. Heather, this is a neat dynamic. A short squeeze is an indication that there are a lot of people betting against a certain stock. And when that happens, if a stock outperforms expectations or there's some kind of catalyst that actually is working in this company's favor, it tends to outperform all of that negativity. A lot of the glass half empty investors will have to cover their short positions, and it can lead to a stock price going up very, very quickly. We refer to that as a squeeze because those that are betting against the stock, when the stock price starts rising very quickly, they have to cover a short position in order to get out rapidly to avoid future losses. So let's define a few terms and set the ground rules of what we're discussing here. There's two important metrics that I want to define right up front before we start getting into the nitty-gritty and into the trenches. The first is short interest, and the second is days to cover. Heather, if possible, perfect. I read my mind. Here we go. What does a short interest mean, and why does it matter to traders? Thank you to Investopedia for providing these great kind of overviews of these investing topics. But basically, a short interest is if you take the total number of shares that a company has and you take the total number of shares that are out there, there's a certain portion of those that are being sold short. What that means is there are certain traders out there who are borrowing the shares, selling them today, and then wanting to buy them back in the future. This is a short position. You're hoping you can buy them back at a lower price than the market is selling them for here today. Because those shares are taken out of the market, they're considered shares sold short. And if we divide that number of short shares by the total number of outstanding shares in the free float, that's what we call a short interest. Free float, by the way, the number of publicly available shares that are out there and are available for trading, right? Some are locked up by insiders. Some of them are just not available when you count the total number of shares. But if you look at kind of the total number of shares that are available to be publicly traded, and then from that denominator, you look at the number of short shares as the numerator. That's what a short interest is, right? And so a lot of times, really, really large companies, which have very, very large trading volumes, perhaps $100 billion plus market caps, you'll only see a short interest of maybe 1 or 2%. 2% of the available shares are being sold short right now. There are not a whole lot of people who typically will sell these large companies short because they're just so established. They've got generally, a lot of coverage, a lot of price targets out there, a lot of institutional following. There's just generally, it's very difficult to make money on very, very large cap companies who already have such an institutional following, at least to short them. But sometimes if you get into the smaller cap waters of companies, you will see a short interest that might be 8 or 10%. That's typically very high when 10% of a company's outstanding share count is being sold short. In fact, sometimes it can be even higher than that. And so when we're working in the small cap field, if we are fishing in the small cap pool, so to speak, there are less shares traded on a daily basis in the market, right? You don't have shares of Apple switching hands every half a second all the time. You have a much, much lower average daily volume of trading that's going on out there. And so in addition to defining what a short interest is, we also define what a days to cover is. If you take the total number of shares that are sold short and divide it by the average daily trading volume of a stock, you can calculate the days to cover. What this essentially tells you is how many full days of the entire trading volume that a stock has on the exchanges that it is traded on would it take to cover all of the outstanding short shares. The total number of shares that are being shorted right now, based on the average daily trading volume, how many total days would it take to cover those? And so a days to cover ratio, again, a measurement of how long it would take for short sellers to close all of their positions, right? If the stock price starts going up very, very aggressively, very quickly, you're going to see a rush to the exits for people that are short to try to get out of these positions. They do not want to get caught holding the bag at the end where they're going to take more and more losses the higher the stock price goes. And so a days to cover ratio will calculate, how many days will it take to cover completely. If you're waiting in the small cap ponds, like we are here for a lot of these short interest companies, you can typically see a days to cover ratio get up to, 2 or 3 days. Kind of a little bit spicier, a little bit more moderate when you see 3 full days of trading that it would take to cover all of a short position. And keep in mind, if there's an earnings announcement or a catalyst that happens, you're going to see a lot of these short positions running for the exits all at the exact same time. So 2 or 3 days to cover would mean it would take a long time for people trying to sell their shares to even sell out in the first place. For them to close out their short positions, not sell their shares. They're trying to buy shares to cover those short positions. Where things get really interesting is when you start seeing a days to cover ratio that increases from beyond 2 or 3 days to cover to maybe 4 days or 5 days or even higher. And if you couple that with a short interest, which is more than, say, 10% of a company's outstanding shares, this is kind of where you start to see the potential setup for a short squeeze to take place. Again, low trading volume, very high days to cover, and the combination of both of those with a very, very high short interest. So let's go back in time, Heather. Let's go back to 2023. 3 years ago at the beginning of the year, there was a company called Upstart Holdings. Many of you watching this program are probably already familiar with this. And I said in, January 20th, 2023, came out there on X, on Twitter, at 7innovator. And I said, Upstart is my top short squeeze candidate for 2023. I saw so many similarities between Upstart in 2023 at the time to what Tesla was displaying back in 2019. There was a lot of people betting against Tesla back then. Nobody thought that the company was going to remain financially solvent, yet it was also ramping up the Model 3 at that time. Tesla went on to soar 743% in 2020. There was certainly too much pessimism in those shares at that time, and you got to multi-bagger within one single year after that setup. Upstart had a similarly fantastic year in 2023. This turned out to be a spot-on call for identifying the short squeeze. In fact, 6 months after this was posted to Twitter on January 20th, by July 20th, 2023, 6 months later, Upstart's stock price was up 220%. There were certain days that it was up 25 or 30% in a single day's trading because it was outperforming earnings. It was gaining momentum. There was a lot of optimism in the stock, counteracting a lot of the pessimism that was showing up in the short interest. And at this time, worth pointing out, Upstart had about 40% plus short interest and almost 6 full days to cover the position. This is why you saw the short squeeze developing with Upstart there. Now comes the fun part. Now we're going to say, hey, based on everything that we saw back in 2023 and then before that in 2019 with Tesla, is there a similar setup today where we're seeing another short squeeze candidate taking place? Are we seeing another setup where you've got a very, very high short interest, where you've got a very, very high days to cover, and also a company that is doing quite well, that seems to be counterintuitive to the pessimism showing up in those short sold positions? I think that there is. And the company that I want to talk about today is called SoundHound AI. Ticker on that one, SOUN. This is a company that is participating in conversational AI. This is a company that, it's building a conversational intelligence platform, which basically means if you talk to it, it's going to understand what you're saying and what you're asking and respond with the most optimal answer, right? We take this for granted because this is something we're so used to with Alexa, with Google Voice, with all of these kind of digital assistants we've got here today. But SoundHound was so early to this game. They've been doing it for a very, very long time. Kevin Mahajer was actually from the University of Toronto in the late 1990s, in the early 2000s, which was kind of the birthplace of modern AI, right? Jeff Hinton was kind of his tutor, his mentor, if you will. kind of the father of modern AI. Kevin goes out there and says, hey, we can build a model fit for purpose for speaking, conversational AI that might be different than the models like Gemini is built for, that might be different than what GPT is built for. People speak differently than we type. And there are some nuances to that are very important. And we've seen this try to be cracked several times in the past. It seems like SoundHound has done very, very well with cracking that nut so far. And so what did they do? First thing first, they went after the automakers. They embedded this in Hyundais and Hondas, where you can actually talk to your car. If the check engine light comes on, you can ask, why is my check engine light coming on? Your car will respond to you in a conversational intelligence platform. Thank you, SoundHound, for doing that. There are certain retail establishments, restaurants, Chipotle, Jersey Mike's, and Torchy's Tacos, 3 examples of where you can actually go up to a stand and place your order just very naturally. You don't have to have a human punching in the buttons anymore. You can just speak to the conversational intelligence platform. Yes, I'd like to have this. Is your order correct? Boom. Save on operational costs for things like that. And even in the enterprise now, you're starting to see through the acquisition that SoundHound made of Amelia and other AI companies as well, it is acquiring its way to get larger and larger so that it can have the enterprise talk to its clients in a way that is very conversational and is responding to questions accurately. Customer service is using this very, very frequently. Insurance claims are being processed in this way very, very frequently. There are ways that the enterprise is actually reducing its operational overhead by using SoundHound's AI platform. And that's why in the most recent quarter, you saw the top line revenue grow 99% year over year, as SoundHound is signing more and more partnerships. It is signing on more and more enterprise customers, moving up market, where it's not just selling to automakers or just to fast food or casual restaurants. It's now working with very, very large insurance companies, banks, and healthcare providers and insurance companies. So really neat company. Now let's dig into why I think that I see a short squeeze developing for SoundHound AI. Again, SOUN if you want to follow along with this one. So let's put that back up there. Let's look at the chart. This is compliments of Ortex, which shows a lot of the really cool information you can see on short interest on some of these metrics that are out there. SoundHound right now has got a 41.6% short interest. That is the percentage of the publicly available shares, known as the free float, that are being sold short right now. 42%. Remember earlier in the program, we said that we thought 8 to 10% was considered high. 41% is very high for a short interest for any company. In addition to that, look at the short interest days to cover right in the middle of the chart there. 2 to 3 days is moderate. 3 to 4 days is getting pretty high. 5 days I consider to be very high. That's a full business trading week to cover a short position. We're now up to almost 6 full days to cover for SoundHound AI. This is very high, ladies and gentlemen. This is a very, very high days to cover. You've got a very, very high short interest. And the chart on the bottom shows you how high or how much these have trended up over the past few years, right? If we're going back in time, you got kind of 1 year ago, you were there in May 2025. You can kind of see, it was pretty typical that the stock has always been kind of at the 20% short interest, maybe even up to 30% short interest. 42% or 41% is almost an all-time high for SoundHound. And that days to cover, if you can see the other orange line there, traditionally kind of were between 3.5, maybe even 4 days to cover. 5.8 days to cover is, again, really high, even for a thinly traded small cap stock that's only got a $3 billion market cap like SoundHound does. You can kind of see the trading volumes down at the bottom there. This is the daily trading volume on a daily basis. Really not that high. Aside from earnings where you see a little bit of a pop here and there, this is the ideal short squeeze candidate in my opinion. So let's open this up and talk about it now. Now that we've identified and we've defined what a short interest is, we've defined what a short days to cover is. We saw how this worked so well with the setup in Upstart in early 2023, where it had 40% plus short interest and almost 6 days to cover for Upstart in 2023. I'm seeing a similar setup here developing for SoundHound today. Again, 5.8 days to cover and a 42% almost short interest for the stock. And again, this is not a company that's dying. It's growing, 99% revenues. It's signing more and more deals. A lot of people have criticized the stock-based compensation, which is really tied more to long-term vesting of its restricted stock units. A lot of things that the market is pessimistic about right now, I think are misguided concerns. I think this is a great company doing some really neat things. And on top of that, you've got a technical setup, which is very attractive for investors. So before I open this up for questions, I do want to point out that SoundHound right now is our number 3 ranked best buy for 7investing. Every month, we come up with 12 strong buys, my dozen favorite companies to purchase for investors in the market, and then identify out of those 12 my 5 best buys each and every month. SoundHound is number 3 on that list. This is a forced ranked list. SoundHound came in at number 3 just because I have a lot of conviction in this right now. And if you want to see that full list of my best buys, check out 7investing.com/subscribe. That's where you can get started with the 7investing premium subscription. And get this, 7 days, your first 7 days are absolutely free. So you can see the best buys that are going to publish later today. You can see the 12 strong buys that were published yesterday. And guess what? There's zero risk attached to this. If you go and you check them out and you just say, hey, 7investing is not for me, I want to cancel it, you get your first 7 days absolutely free. I, of course, would love you to stick around and love you to look at all of our premium content. And if you do want to stick around, it's only $199 for the full year for 7investing. You get all of the best buys, you get all the strong buys, you get all of the monthly recommendations, the official scorecard. It's all there for you. I think that $200 a year, being someone who's worked in this industry for the past 15 years, I think 7investing is a very attractive price point for the individual investor to go out there and be buying stocks that are very, very high quality. And I've got higher risk, but sometimes I've also got that huge opportunity like we saw here with SoundHound. And a reminder, SoundHound is number 3 on the list. There's 2 other companies that have ranked even higher than SoundHound on the best buys list. Check it out, 7investing.com/subscribe. With that little infomercial in place, Heather, I'm ready for your questions about SoundHound. Really cool setup here right now. I think this could be a short squeeze that's quite refreshing.
So, yeah, I'm really excited about this. Why are they being punished so desperately? Is it just lack of seen moat or competition?
That's one of the reasons. There could be pessimism in the stock itself or the company's performance. A lot of times with small companies like this that are in hot sectors, investors will kind of step back and say, hey, great, 100% annual revenue growth. That's great, but that's not the same as cash flow. We're staying out, or we're actually going to not take a position until you can start showing us that you're growing not just the top line, but the bottom line. Right now, SoundHound is making a lot of acquisitions. They're not organically profitable, at least on a free cash flow basis. They're going out, they're acquiring companies, they're building out these relationships. You're spending a lot of money on R&D on that conversational intelligence platform. I think that's one reason, like you just mentioned, pessimism for the stock. There's a second reason too, though, which is manipulation of small cap stocks. If you're a short seller and you kind of see the herd descending on a fallen prey, if you will, you tend to pile on, right? When you see short interest rising and days to cover rising, that's kind of a sign for you to say, hey, there's a lot of selling pressure on the stock right now. You can probably make some money in the interim, in the short term, by betting against a company like this because there's so many others that are doing exactly the same thing. That's just kind of how the market works, right? If you can go out and take advantage of an opportunity like that, you do it. Until that works until it doesn't, right? The worst thing possible if you're a short seller is you see a short squeeze where you lose a lot of money very, very quickly, and then the strategy you use just simply doesn't work anymore. And so rather than going out there and finding the companies that are just traditionally beat up and have zero catalysts, which are going to be fall and prey like this for a long period of time, you look for the ones that might outperform on an earnings announcement, might announce a new partnership, might announce a new acquisition. I mean, there's plenty of catalysts right now for SoundHound that can get it out of this and initiate that first step for a short squeeze. That's why I think it's a great candidate. It's not a bad company. It's not a beaten down stock. It's just one that's out of favor right now that could quickly return its fortunes.
So, how do you like to play these stocks? Do you like to buy and hold? And so, as the short squeeze pressures fail, yeah, how do you like to play these?
So, full disclaimer, I still own Tesla. I still own Upstart, and those were 2 short squeeze candidates from 2019 and then 2023. I do own a position in SoundHound right now. I'm not planning on selling anything based on a squeeze itself. I think that's kind of an added benefit for a long-term investment if you can see something like that. But again, teach their own, right? There's a zillion ways to invest. It's a very personal thing. I have nothing against the stock market rewarding people financially for making the right decisions. If that's a short squeeze and it's a shorter term period or a period duration, nothing wrong with that as well.
Makes sense. How long? I mean, 6 days is a lot. Do you think that's going to keep increasing, or do you think we're very close to the squeeze?
We're going to hit an inflection point, right? There's going to be something that breaks on this. You can't have a stock that keeps going up to 5 to 6 to 8 to 10 days short. It's going to break one way or the other. I think there may be one of the, back to your question of why are people betting against this, is if you have selling pressure pushing down the stock price of a company that is not yet profitable organically, not adding cash to the bank on a quarter over quarter basis, but it needs that cash, right? It wants to go out there and make acquisitions. It needs to fund its business, it needs to pay its salaries of its employees. At some point, the best case scenario for a short seller is they have to go out and they have to issue equity. They have to raise a secondary offering at the worst time possible. Your stock price is really low. That dilutes shareholders, it pushes the stock price down, but now there's more shares available. So you tend to kind of see a normalization of those days to cover in the short interest. More shares available because you had to issue a secondary offering. That's the best case scenario. And the opposite is where you see a lot of buying pressure, where you see a lot of people that are going to say, hey, we're going to close out these positions. 41% short interest is very, very high. SoundHound did something really, really good. Maybe there's a lot more optimism in the shares right now. Maybe they don't have to go out there and issue equity. That would be the opposite scenario there too. But one way or the other, this is going to break at some point, Heather. We're not going to go 6 more months with SoundHound sitting at 40% short interest and 6 days to cover.
Yeah, that's not a very sustainable place for a stock to be. What do you think? I mean, you've mentioned different catalysts. Do they have earnings coming up soon?
Let's see. When do we have SoundHound earnings come out? We can probably pull that up really quickly.
We may be past that, but yeah, what catalyst do you think is going to click it, or is it just impossible to say?
The earnings for the upcoming second quarter will be on August 5th. So let's see, what does that put us 2 weeks out or so? That could very well be the catalyst, is another really good earnings report where you're reporting, hey, new partnership, new deal. They're working right now with the Japanese automaker. They claim is going to be a transformational deal in the automotive market. It could be a technology conference. You start getting some institutional investors that are interested and they start taking positions. You get some funds putting some big money into things like this. Could be a new hire. Maybe they bring in somebody, to the team where you say, hey, wow, they've got some great experience. We're really optimistic about where they're going to bring this company going forward. Or a zillion other things too. There's something that's going to happen probably within the next month or two. Earnings could certainly be that, though. Absolutely.
It's kind of it feels like a more advanced investor strategy. Is this something that the average investor should be playing with, you think? Or is this something that you really want guidance from something like 7investing or just?
I will say I was a fundamentals-based investor first and foremost, right? The way that kind of typically, if you're playing the stock market, the first thing you look at is, earnings, and then you kind of peel back the next layer of like, why are they outperforming earnings? What are the programs that are driving the top line? What's driving the cash flows? All of these fundamentals about the company's performance. That's typically where we go first when we're looking at stocks. And there's nothing wrong with only looking at the fundamentals. That's actually a perfectly fine way to play the stock market. I will say though, in the last, 6 years that we've had 7investing open, our doors opened on March 1st, 2020, I will say I've gotten a much more of an appreciation for the dynamic of the market itself. The market is a giant auction, right? This is a giant trading auction where people are pushing buttons on computer screens to trade stocks. And there is some kind of behavioral analysis layered on top of that. And you tend to recognize these types of patterns in a way that might not always be obvious when you're just looking at the fundamentals of a company, right? You can see companies doing great fundamentally, growing top line, growing bottom line, growing cash flows, seem like they're cheap and they just can't get any momentum out there. That's when you start layering in technical analysis, the things like we were talking about in this show. So I think it's a more sophisticated complementary type of analysis that goes very, very well hand in hand with fundamental analysis. I'm not sure if I would look at just one or the other and ignore the other of those. But I think that if you're looking and you appreciate, a good company with good fundamentals that's growing, a valuation that's attractive and not overpriced, and then you've got some really good technical indicators out there. The kind of the combination of those is a holy grail that can be a setup like we're talking about here with SoundHound here today.
If anyone has any questions, you can throw them in the chat and we'll try to answer them. I will say something that really just changed my view of investing forever was talking to someone. I was actually learning about covered calls and options, and talking about how, one, the stock market is not this logical machine. There's a lot of human emotion and like beliefs that are inside of the stock market, as well as there are people with different goals. Like individual investors want to max out their potential, when a lot of institution investing wants to limit risk, and therefore they'll make decisions that like don't really logically make sense to an individual investor until you realize that it's not about maximizing profit, it's about minimizing risk. But yeah, it's definitely a place that you should be thinking, how are people's emotions playing into their investing, and you don't want to lose that layer completely.
I think that's spot on, Heather. I think that generally the market, you can spot over time that when it's being irrational. You can spot when a stock is egregiously overvalued. You can spot when a stock is egregiously undervalued. Now, the problem is you don't know how long that's going to last, right? And so sometimes when we play with options, we do things that we think are going to happen next week or next month, and then it takes 2 years to play out, right? It takes 2 years for the market to correct its irrational behavior. But if it's done responsibly, like you mentioned, covered calls, there's nothing wrong with saying, hey, this stock is really, really expensive right now. I don't think it's going to stay here for another year or 2 years. And if you've got the shares anyway and you're willing to give them up at a premium, you can sell a covered call and make another, 8, 10, 20% on that position for the year just by selling the covered call. It's an option strategy you could use. Same thing with, selling puts, writing puts if you wanted to. If a stock is really, really cheap, and you say, hey, I'll be willing to buy that. I don't need to necessarily buy it today, but I'll write an option to buy it at this price in the future. If it corrects and it goes back up, great, you just collect the premium. If it stays down, you buy the shares anyway. I mean, this is kind of the complements that we look at based on the irrationalities of the market. And again, you can see that from fundamentals perfectly fine. You can just look at valuations of fundamentals all the way. The technical piece of them, which is like we talked about today, days to cover, short interest, tend to be, in my opinion, a little bit shorter in duration, right? We're not looking at 2 or 3 years. This is something I think, like I said earlier on the show, it's going to correct itself within 6 months, one way or the other. And plan that accordingly. I don't want anyone YOLOing and then, writing in the comments, hey, Simon, you told me to go out there and, back up the truck on SoundHound options right now. Don't do that. Make sure you know yourself. Investing is personal. Know your risk tolerance. Don't do anything crazy. Don't scream YOLO when you're pushing the button. But on the other hand, it is, you can spot irrationalities out there. And in my opinion, this falls firmly into that camp. And so perhaps we'll end it there. We're at the end of the program here today. But one thing that Heather and I have been talking about, and I want to bring this as the perfect segue to it, is small cap stocks. We were talking just earlier, last week's show about, can you go out there and look in the small cap ponds and find opportunities that are intriguing? We talked about SoundHound today. It's a $3 billion market cap. Are there other stocks out there that are either egregiously undervalued or egregiously overvalued right now? Perhaps there's certain AI companies that might be overvalued right now. There might be certain healthcare or retail companies that are egregiously undervalued. We're going to find some of those on the next show. I think we're going to do that either on Friday or Monday as we come up, because I really like kind of playing this pond too. I'm not afraid to go there. I'm not afraid to talk about small cap stocks that are riskier. We just have to understand those risks and know what we're getting into. So we're going to look at one of those in the upcoming program. But again, today, the conversational topic, SoundHound, SOUN. If you want to follow along with that, 7investing.com/SOUN. If you want to look at our coverage of SoundHound, we're 7investing.com/subscribe. Again, if you want to take advantage of that 7-day free trial and see how SoundHound fits with the other best buys that we just published today. Appreciate you tuning in for this show. Had some good live participation. Saw a lot of you here in the chat room with us. We'll be back again soon. I hope in the meantime that you have a great week, and we'll see you again soon.